Open any investment app right now. Look at the numbers, the account balance, the funds listed, the allocation percentages. It probably looks fine. Stable, under control, like something a responsible adult built over decades of careful decisions. But here's what those screens don't show. Most Gen X investors are quietly making the same set of mistakes, right now, today, in their current portfolios, that will cost them hundreds of thousands of dollars before they ever reach retirement. Not because they're careless, because these mistakes feel exactly like the right thing to do. They feel cautious. They feel smart. They feel responsible. And that's precisely what makes them so expensive. Like, subscribe, and let's start. Number 1. The catch-up window they're not using. Here's something most Gen X people don't know about their own situation. In most countries, tax-advantaged retirement accounts allow higher annual contribution limits for people over 50. The logic is simple. Younger workers have decades of compounding ahead of them. People in their 50s have a shorter runway, so governments allow them to contribute more, tax-advantaged, to close the gap. Most Gen X people aren't using this. Not because they can't, because nobody explained it clearly. Or they assume their current contribution level is enough. Or the paperwork seems complicated and life is busy. Here's what ignoring that extra contribution window actually costs. An additional $6,000 per year invested from age 50 to 62, 12 years, at a 7% annual return. $107,000. That's not a theoretical projection. That's standard compound growth math. $6,000 per year, contributed consistently, growing at a rate that diversified global equity funds have historically exceeded over long periods. $107,000 in additional retirement money. Available right now. Sitting unclaimed because nobody updated their contribution settings. And the cost goes beyond the money itself. Contributions into tax-advantaged retirement accounts grow without annual tax drag. The real after-tax value of not using that extra window is even higher than the headline number suggests. Gen X is leaving over $100,000 on the table by not knowing the rules of their own accounts. Check the contribution limits in your country. Check what you're currently contributing. The gap between those two numbers is money the government is allowing you to protect, and most Gen X people are handing it back. Number 2. The forgotten portfolio. Set it, never touched it. Here's a question worth sitting with. When did you last actually look at what you're invested in? Not the balance, the actual funds, the actual allocation, the actual split between growth assets and defensive assets. When did you last change anything deliberately? For many Gen X investors, the honest answer is years ago, maybe a decade. They chose their funds at 38 or 42, selected something that seemed balanced at the time, and never revisited it. Life got busy. The statements kept arriving, the balance kept growing. It felt handled. But the portfolio they built at 40 is now managing their retirement at 55. And those are not the same financial situation. Here's what the numbers say. A $300,000 portfolio allocated too conservatively for a 55-year-old, 40% in growth assets, 60% in defensive assets, growing at an average of approximately 5.2% annually for 15 years, $642,000. The same $300,000 in an allocation more appropriate for someone still 15 years from retirement, 70% growth assets, 30% defensive, at approximately 7.5% annually, $888,000. Difference, $246,000, from never updating a form. And the conservative allocation doesn't just underperform. In certain economic environments, rising inflation, rising interest rates, bonds and cash equivalents can lose real value. The safe allocation of one decade is not automatically the safe allocation of the next. A portfolio that was never revisited is a portfolio that's been making decisions without its owner. The revisit takes less than an hour. The cost of not doing it is $246,000. Number 3. The fee nobody reads. Small percentage, large damage. Most Gen X investors don't know their expense ratio. Not approximately, not roughly. They genuinely don't know what percentage of their portfolio disappears every year in management fees. The number is buried in fund documents that nobody reads. It never appears as a deduction on a statement. It quietly reduces the rate of return, year after year, invisibly. Here's what that invisible number does to a real portfolio. $400,000 in a retirement account with 15 years until retirement, invested in a low-cost global index fund with an expense ratio of 0.03%, available from providers like Vanguard, Fidelity, and similar institutions in most English-speaking countries, at a net annual return of approximately 6.97%. Final value of $1,099,000. Invested in an actively managed fund with an expense ratio of 0.75%, a common rate across many fund families globally, at a net annual return of approximately 6.25%. Final value of $993,000. Difference: $106,000. For choosing a different fund that holds largely the same underlying assets. And 0.75% is a moderate figure. Many GenX portfolios contain funds charging 1% or more. Products sold to them in the 1990s and early 2000s, when index funds were considered boring and actively managed funds were marketed as the sophisticated professional choice. The data on this is not disputed. Over any meaningful time period, 10, 15, 20 years, the majority of actively managed funds underperform their benchmark index after fees. GenX paid a premium for funds that delivered less, and many of them are still paying that premium today, in accounts they haven't opened since the last time their advisor called. Checking the expense ratio on every fund currently held takes approximately 20 minutes. That 20 minutes could recover $106,000. Number 4. The cash that feels safe but isn't working. In recent years, savings account interest rates have risen meaningfully in many countries. High-yield savings accounts are now paying rates that feel significant compared to the near-zero returns of the previous decade. And GenX, trained by experience to be cautious with money, has responded by moving meaningful amounts into savings accounts, money market funds, and term deposits. It feels like the right response to uncertainty. But here's what that decision is actually costing. $100,000 sitting in a savings account at 3.5% annual interest for 10 years becomes $141,000. The same $100,000 invested in a diversified global index fund at a conservative historical average of 8.5% annually over the same 10 years becomes $226,000. Difference? $85,000. And that's assuming savings rates stay at today's elevated levels for the full decade. They won't. Savings rates follow central bank policy. When rates fall, and they always eventually do, those attractive yields disappear. A diversified equity portfolio keeps compounding regardless of what central banks decide. GenX treats savings accounts as an investment strategy. They're not. They're a waiting room. Money in a savings account is money waiting to be deployed. As a short-term emergency reserve, 3 to 6 months of living expenses, it's essential and irreplaceable. As a long-term vehicle for money that won't be needed for a decade, it's an expensive substitute for an actual investment plan. The comfort of a stable number on the screen has a price. That price is approximately $85,000 per $100,000 held in cash over 10 years. Number 5. The concentration risk nobody mentions. Here's the last mistake, and it tends to be the most emotionally complicated. GenX often holds a disproportionate amount of their portfolio in a single stock. Sometimes it's the company they currently work for, accumulated through years of employee share plans or stock grants. Sometimes it's a stock they bought early in their career and watched appreciate significantly. Sometimes it's shares in a family business. It feels like loyalty, like reward, like something earned through years of commitment. Financially, it's one of the most dangerous positions a retirement portfolio can hold. Consider this. A GenX investor with a $450,000 portfolio has 35%, approximately $157,500, concentrated in a single company's shares. The remaining 65% is diversified across various funds. That concentration might seem manageable, moderate even. But if that single stock drops 50%, not a collapse, not a fraud, simply a difficult year in its sector, $78,750 disappears from the portfolio. The total account falls from $450,000 to $371,000. A 17.5% portfolio loss driven entirely by one position in one company. Single stocks drop 50% regularly. Established, well-known companies with long track records have lost half their value within 12 months across various markets in recent years. It doesn't require scandal or bankruptcy. It requires a bad earnings cycle, a sector rotation, or a shift in market sentiment. Diversification is not a theory or a preference. It is the only mechanism that structurally protects a portfolio from the permanent damage that a single concentrated position can cause. The loyalty GenX feels toward a stock that got them here is one of the most expensive emotions a portfolio carries. The audit that matters right now. 4 things to check this week. Are you contributing the maximum allowed by your government's rules for your age group, including any additional amounts permitted for people over 50? If not, log into your account today and find out what you're leaving behind. What is the expense ratio of every fund you currently hold? If anything is above 0.5%, research a low-cost index alternative from a reputable provider available in your country. When did you last update your allocation? If the answer is more than 3 years ago, it needs a review. The right portfolio for your age today is probably not the same as the right portfolio for your age in 2012. Does any single stock represent more than 10% of your total portfolio? If yes, that concentration is an uncompensated risk that quietly threatens everything else you've built. GenX spent decades building something real. The mistakes happening right now in current portfolios, on current platforms, through current fund choices are not dramatic. They don't feel like mistakes at all. They feel like caution, like stability, like being responsible. But the math doesn't care how responsible the mistake felt. It just counts the cost. I'll see you in the next video.